Hey everyone, and welcome to today's show on Wealth Strategy Secrets. Today we are joined by Hunter Thompson. Hunter is a full-time real estate investor and founder of Asym Capital. Since founding Asym, Hunter has helped more than 400 retail investors acquire over 150 million of mobile home parks, self-storage, retail, office, ATM machines, and cryptocurrency assets. Hunter is also the host of the Cash Flow Connections Real Estate Podcast, which has received over 1 million downloads. Congrats on that. He also wrote Raising Capital for Real Estate, which hit #1 on Amazon in real estate sales and selling. Congrats on that as well. I've read the book. Hunter, my friend, so good to have you on the show. I've really been looking forward to this, and I know listeners are really going to get a lot of value from this episode.
Happy to do it. Excited for this conversation.
Awesome. So why don't we kick things off and talk a little bit about your journey and what really got you into this space of real estate? How did everything really start for you?
So I started this journey around 2008. I think a lot of people started their story. Some part of their story has 2008 in it. For me, I was very insulated from that risk because I was still in college at the time. And when 2008 happened, it got my attention. The financial sector was obviously very depressed and deflated, and I heard a lot of billionaire quotes about buying when blood is in the streets, and was like, okay, this is clearly one of those moments, and just went all in on education. I started reading Warren Buffett, Charlie Munger, and learned about stocks and mutual funds and things like that, and started investing in blue chip stocks. I had a background as an entrepreneur and formerly a poker player. So just kind of, investing my money accordingly. And I learned a lot, and even started day trading and stuff like that, just as an amateur. But something happened in 2010 that no one talks about that just basically changed my whole worldview, which was the European debt crisis. And the reason this was so impactful is that I spent all this time studying, and obviously I'm a young kid at the time. I figured, I've got this thing locked up, and leading into, obviously you had to win starting in 2008, but I didn't know enough about bubbles and such at the time. And then all of a sudden, intraday 700-point Dow Jones swing starts taking place. And I'm thinking, how in the world could I have mitigated myself against the German bond yields, where everyone in CNBC, and this was like my idols at the time, Jim Cramer being like, well, if the Greece bond yields or German bond yields hit 7%, then everyone knows the economy is going to collapse. It's like, what? There's no way. Even if I had 100 Wharton grads working for me 50 hours a week, no one would have said something about that. And even if they had, they would have lost their job because that's ridiculous, right? So I realized that the financial sector, despite all this chat about diversification, it didn't matter if you had Apple stock and Johnson & Johnson stock and some good yielding bonds. Everything was under the control of the German bond yields. And I realized that's far more complicated than something I can control and mitigate. I had to find something that was simple enough that I could predict and control without some massive infrastructure. And I was not sympathetic to real estate initially. I just eventually found my way to what I think is probably the most predictable wealth creation tool in the world. And so here we are today.
Which is?
Recession-resistant real estate, particularly multifamily mobile home parks and self-storage.
Okay. And so let's go into that. And why would you, pick those asset classes? What is some of the attributes of those asset classes that resonate for you compared to paper assets?
So you cannot help but be impacted by the tattoos you get as you grow up, right? And for me, again, that 2008, 9, 10 moment was like the forming years of my views on a lot of this stuff. So I moved to California, which was one of the most decimated states in the country. And I wanted to be a real estate entrepreneur. And so I started going to these networking events, and I was just joking around with someone saying that those meetings were like, they had the temperament. I mean, it was just devastating. I mean, everyone had lost their shirt. People had made $10 million, lost it all, lost friends, divorces were taking place. I mean, this is no exaggeration. It is as real as it got. And I saw what it looks like when things get devastated. And so I kind of looked at the economic data pretty objectively because I was not emotional about it. I just saw what was going on and realized, there are certain investment strategies, risk profiles, and tactics that lend itself to being highly cyclical in nature. And there's some that aren't. So, development, hospitality, land entitlement, you're going to get rocked every 5 to 8 years. And I figured I'm willing to give up the potential upside associated with that in exchange for predictable outcome. And so I went all in on, especially at the time, the mobile home park business, which was trading at 10 caps, the self-storage business, which is trading at like 8 caps or so, and then later the multifamily apartments. And I've made some mistakes in my career, and we can talk about those, but probably one of the most proud things in my whole career is if you Google Green Street Advisors NOI growth over same store assets across multiple asset classes, something similar to that, you'll find a chart which shows mobile home parks and self-storage as being the leading NOI growth asset classes coming out of the recession, and it's not even close. And so I got that one right. And the way I got it right was different than getting it right if you invest in Dogecoin. I got it right because NOI growth is based on fundamentals. And I love that you can just invest in things based on supply and demand. And if that NOI grows, you're going to be printing money. And that's exactly what happened.
Yeah, absolutely. So did you lose a lot? Did you have a large loss at that time, or was it more of a light bulb moment for you?
It was not a loss. It was the emotional component of watching this happen and being completely out of control. So
Out of control.
I'm in California, we're getting, stop sell alerts where it's like, oh, 700 points in the Dow Jones, sell. Oh, up 800 points, buy. It's like, okay, now I've got to wake up at 4 a.m. to like be at market timing. And I just wasn't cut out for that emotionally. And
Yeah.
that's where the change came from. But no, I didn't really, other than those like auto sell features, significant losses wasn't the reason. It was just like, this is a straight up casino.
Right. No, and it's great that you bring out that point because, we're always talking about that with investors and everything. And part of this entire strategy really is it's taking back control, right, of your own personal economy, right, and being the CFO of your own finances for your family, right, where most of us are taught, right, through conventional wisdom that we're going to give our money to a financial planner. We're going to put it in 401ks because that's the best thing you could do. If you have kids, you're going to put it into 529 plans, right? Because that's what we're told. I mean, that's conventional wisdom. Everyone is really teaching that. But really, these government sponsored plans, you've given up complete control. You can't access it till you're 59 and a half. There's rules on how you take it out. There's different tax implications, upon taking it out. So, one of the things that resonates, with your story as well, right, is in this strategy, and by investing in real estate and some of these other asset classes, you have control, right, at multiple levels. And yes, as an LP, I mean, okay, to some extent, right, but you're directing your capital. You're starting to de-risk yourself as cash flow comes in, right? What are some of the other things, that you've noticed in terms of, taking control back?
Well, I think first of all, this conversation has evolved tremendously in the right direction over the last 10 years. The Jobs Act happened in 2012. I started investing in this business prior to that even happening. So when I started my career in real estate, you couldn't even talk about these deals on the internet. So the Jobs Act created this massive tailwind where now everyone can Google and find great opportunities. The problem though, is that not all deals on the internet are great opportunities. So like
Right.
something that you and I are trying to do our best job of is get quality information out there, not to just say rah, 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 go crazy, but to say like, let's take a sophisticated look at this stuff as we mature as investors. So to your point, everybody owes it to themselves to play a significant role in their portfolio. Like you cannot deflect that 100% off to someone else. Being an LP investor, for example, is not relinquishing that control. As an LP investor, you're deciding, whose investment thesis makes more sense. Are you more inclined to something like development? Are you willing to forgo 3 years of cash flow for a potentially massive IRR? I personally wasn't, but at the same time, the nicest house I've ever been in is in Beverly Hills. The floors were marble, and it was some massive, probably, I don't want to say the exact number, but a top 10 most active developer in Southern California. So like, if that's the route you want to go and you want to have the marble floors, like that's a path. But I just thought, if I could produce 15, 16% IRRs consistently across multiple stages of the cycle, we'll see how this plays out over the next 30 years, especially with the emotional component. So I don't know if I answered your question, but that's kind of my
Yeah,
thoughts.
no, absolutely. And maybe tell the audience a little bit. I know, part of your investment thesis as well is talking about asymmetric risk, right? Which we talk about. So maybe just take a moment to tell everyone, what does really asymmetric mean in the world of investing and these types of asset classes to you?
So I think these conversations are this is awesome to have. And the reason we use that terminology is we're trying to talk to people who are thinking about their investments through a risk adjusted lens. And so I'll give you like an example of so in the stock market, if I'm willing to invest in something and I think the returns are going to be very high, it's necessarily the case in a publicly traded market in particular that there's going to be more risk with higher returns because it's publicly available. There's no nuance. It's very difficult to have insider information. It's usually illegal to do so. In the world of real estate, you can find situations where increased returns are achievable without incurring risk proportionately. I'll give you an example. Self-storage. If we buy self-storage property and we have a property, let's say that's 8 miles away, and the property that we own, we have an affiliate relationship with U-Haul where we allow U-Haul to park their trucks on our property and U-Haul rents those trucks out to our clients. We get, let's say, $1,500 a month as an affiliate fee from U-Haul. That, to be able to buy another property 8 miles away that doesn't have that one strategy, to buy it based on its current in-place NOI, and then simply call our affiliate partner at U-Haul and say, hey, go park half those trucks over our new property and turn on the additional $1,500 a month, basically overnight, without owning the trucks, without maintaining the trucks, without doing any additional marketing. That to me, I mean, what's 1,500 times 12 divided by a 6 cap? I mean, you're talking about hundreds of thousands of dollars without incurring capital expenditure risk. Now, on the other side of that, let's say I were to buy a C-class apartment and turn it into an A-class apartment. I'm going to go through capital expenditure. I'm going to go through business plan implementation risk. And you're starting to be like, that's more of a symmetric type of return. Yes, it's a great strategy, but you're going to have to pay in capital and risk to implement that. So like, we want to do a combination of both. I want to find some multifamily self-storage mobile home park and other assets where there's a potential for adding additional revenue streams without incurring proportional risk, and then supplement that by more typical strategies.
Yeah, absolutely. I mean, it is interesting because the other lens that I would put on it is, I like to call these types of asset classes is being multidimensional in nature. Right? Because we're trained really, again, from Wall Street to just be thinking, what's the ROI on something? Right? This stock is at 9%, this one's doing 12%. And that's kind of all we think about, right? And we're just saying, okay, well, the 12% must be better than the 9%, right? So I'll take that. But all we're doing is thinking that the stock can actually go up, right? Unless you're trading, but stocks can go sideways and they can also go down, right? But in these types of assets, right, we're talking about tax efficiency, right, which is a huge component, and I think mostly underestimated by many investors. So you have the tax efficiency side of it. You also have this cash flow side, right, which is really the theory around passive income type theory, and trying to drive cash flow as much as you can, which also de-risks you from the deal, right? Every month you get payments, and then you do have a big, potentially a lucrative upside, right? If you can achieve a 2x type of return. So when you start to add these multiple dimensions together, it starts to become quite compelling, right?
It's so interesting because I don't remember where this was, but it was someone of a very high level person that I was able to interview that said, look, all these little real estate deals are businesses. They're all little businesses. Like they all have their own balance sheet, their own cash flow situation, their own thesis, risk profile, manager, et cetera. That is what's so, so cool about this. And to your point, I was in Denver once on a property visit. And we're looking at this asset they had purchased in, I think, 1998. And really nice asset. Everybody listening to this probably knows what's happened in Denver over the last decade. They put $600,000 into the asset, bought it in cash. They had refinanced $2 million. That doesn't include the cash flow. That doesn't include the actual value of the asset. They have refinanced $2 million, which, by the way, is not a taxable event. You're just borrowing money. So like that story, that's the way that real, and I mean real, multi-generational wealth is created in this country, by holding solid fundamental assets and then potentially refinancing forever, or implementing some sort of 1031 exchange strategy. So defer, grow, and basically, hold for cash flow. And by the way, just one real quick thing about like stocks and dividends versus what we're talking about. In the blue chip stock world, which is what most people invest in, the average cash flow is about 1.4%, somewhere in that range. If you were to ask the average person what their financial goals are, they're going to tell you, like if you really get into it, right, they're going to tell you that they want to be able to have their passive cash flow paid off and have their expenses paid by their passive cash flow. You got to have like a $30 million net worth to be able to do that with blue chip stocks. You can do it far more quickly, far more effectively, especially when it comes to like the tax strategy and the risk strategy, by implementing the stuff that we're talking about.
Yeah, absolutely. So I think this is a good segue as well, Hunter. So we talk a lot, our show is really, focused on wealth strategy. My book was around wealth strategy because I think, again, as you layer on all these different dimensions, it's just kind of this compounding effect that really snowballs, with your strategy. So can you tell us a little bit about your personal wealth strategy, how you're seeing the world as really a professional investor, you personally?
Yeah. So, I mean, first of all, I'm going to do a quick little thank you for you, not now, but I'll tie it in because you definitely helped me in terms of one of these main pillars. But generally speaking, about 90% of my net worth is in the types of investments that we outlined today. I mean, I'm a real serious believer in private investments in private real estate deals.
Yeah.
So regardless of what I say from here on out, that is what speaks. I'm a big fan of Peter Schiff in terms of content he creates, but it's not like 90% of his net worth is in gold. You know what I mean? Right. So like, I really, really believe this stuff. And if anybody wants to ask me about the specifics of the percentages, I actually think I did a podcast about it not too long ago. I'll shoot from the hip to give you some kind of more context there. I think about 60% or so is in a combination of mobile home parks and self-storage. About 20% or so is in multifamily, and the rest is in a combination of other asset classes, retail, industrial, et cetera. Over the next 2 years, I think multifamily will probably account for about 50% of my net worth or more. And the reason for this is that my investment thesis never changes, but the percentages do change. So there was a time when I thought the mobile home park business was by far and away the most attractive risk-adjusted investment possible. 2012, 13, 14 or so. The cap rates were just so high, they just didn't make any sense to me. And I thought, either this is like a farce and I am investing in a Ponzi scheme, or this is going to be over soon. And it ended up being real. It was just over. People figured it out. When that happened, there was a time where mobile home parks would trade at a 400 basis point delta to multifamily apartments. You could buy 6% cap rate multifamily apartment and a 10% cap rate mobile home park. But now everything's been smushed so that now things are like, 3.5 cap in multifamily and a 4 cap in mobile home parks. So that lack of a delta makes multifamily comparatively far more compelling. So because of that, we'll ramp up the allocation for my personal investments and for our investors to focus on multifamily and still pursue the others as well. It's a very slow and steady strategy that if you talk to me in 30 years, I'll probably be talking about the exact same stuff, but the percentages will just change.
Right. Do you have any personal goals in terms of passive income amounts within a given year or equity amounts?
Good question, dude. So I'll think of kind of like what I think about that, but I'll start it with this. Everyone that I've talked to, when they get into the space, the goal is to have their passive income paid off by their expenses, right? And that's not like the first goal of finance. There's a lot of goals, but that's one of them, right? And so whenever someone asked me a long time ago, that's what I would answer, until I was at a conference and someone raised their hand at the beginning of the conference, said they had an exciting thing that they wanted to announce. And this person came up in the stage. I don't know why they were let at the time. I didn't know why they were let up to go up there, but they went up there and they said, hey, I achieved my long-term financial goal, which was to have my passive cash flow 10x my passive investments. And I was like, excuse me, my expenses, my passive cash flow is 10x my expenses. And he's a very frugal person, but that means that he was definitely making $100,000 a month passively, tax deferred, through the strategies that we're talking about. And that changed my perspective on what's possible. I mean, I was like, wait a minute, what would that be like? And internally, like at Asym Capital, the way that we answer that question when it comes to anything, we have some specifics. We want to raise $40 million this year, purchase around $120 million worth of real estate. We're on track to do that, which is cool. But the real answer to your question, man, I mean, you mentioned that I wrote a book called Raising Capital for Real Estate. Sometimes when I go to real estate conferences, I'll meet people that will say, this book changed my life and you put me on this path and you helped me tremendously. We have, as you know, we have a coaching program called Raise Masters, which helps people raise money for their deals. And we've had some crazy success stories from people that are raising their first $500,000 to people that just raised their 75th million dollars. And so what intuitively, what you're kind of asking me is, how much more do you want of that? And so what we say internally is, it's not about the thousands, the tens of thousands, the hundreds of thousands, the millions, or the tens of millions. It's about the multiples. The answer is more, a lot more, because I feel like I've been put on this planet to help people do two things: raise capital for their deals to achieve their goals as an entrepreneur, and get money out of the stock market casino. So how much? More.
Yeah, absolutely. It is very interesting because you're right. As people always talk about, hey, I want to get out of the rat race, and you pay off your expenses. But look, I mean, that can be pretty easy if you live cheaply. Right? So I don't want to live. I want to live a life of abundance. And what I also have a little phrase for is called abundant complacency. So let's say, once you actually achieve that, where you have exceeded, right, your passive income is exceeding your expenses, the mind starts to wander, right? You start to become kind of complacent, maybe, and taken out of a growth oriented mindset, right? So when you then start to talk about, what you just talked about, and start to think about a large growth impact and actually having a greater impact, and also it's really about fulfillment, right? Like I can't stand this whole word of retirement, right? Because you're putting something out to pasture. It's like, if you love what you're doing, regardless of what your age is, you should keep doing it, right? So part of this also, it's not only about, taking control, being smarter about the asset classes that you're in, but being more fulfilled, right, with what you're doing. And if you can create more impact for helping others, such as you're doing, what an awesome life, right? What a way to live an extraordinary life.
Totally. Can I talk quickly about the whole frugal stuff? Because I feel like you and I are kind of—
I know you have some thoughts here. Yeah.
Well, it's because a couple times in my life, I've been sent down a weird path and I try to force it. And then once I realized I didn't have to go down that path, everything changed. So the reason I talk about it is that perhaps someone's listening to this that's in one of those situations. So, my early mentors were very, very frugal people that made choices, to save money, which is fine. But I tried to force that into my life. And a book that everyone in the beginning of my career, everyone was suggesting that I read The Millionaire Next Door. And I just was like, yeah, that's it. Like, okay, I'm just trying. And someone eventually said, hey, that's trash.
Yeah,
said, hey,
exactly.
That's a trash way of thinking. Stop that trash thinking and explode the top line and take everyone with you. And it completely changed my life in the sense of, I'm not a car guy, but now I realize there's this thing that people talk about like in growth, in Tony Robbins and such, and they talk about this transition from growth to contribution. At first, you've got to grow. You've got to make your millions. You've got to be able to be secure in your financial situation. And then if you really want to go to the next level, you need to focus on contribution, to focus on others, to bring others so that they can go through that growth phase with you. But I think there's a third stage, not that I know more than Tony, but I've always thought the next stage is inspiration. And I think that's a reason that we see a lot of those cars and a lot of these nice houses, because you want someone to see that Lambo and go, damn, that guy's an idiot. I could probably do that. And it's true. It's totally true. You totally can. And it's just one more person that can. And I really like, I'm not a car guy, but I am a house guy. And trust me, I'm going to have one of those houses and it's going to be awesome. And it's going to be one more proof that you can have one too. It's not a zero-sum game. It's very much the opposite. Capitalism requires interface. And man, all the coolest technologies in the world, they're at first invented to cater to people that have achieved those things because they're $900 cell phone. But then what happens? All of a sudden, everyone has a cell phone, every income level because of that. So I'm trying to make that happen. I want to invent some products, and I know you do too.
Oh yeah, I have plenty of ideas here. But if you actually do some deep thinking about it, and this is always fascinating to me because a lot of this is really like the psychology of money, right? And what does it really mean to you or, and anyone else? And it's kind of really parallels Maslow's hierarchy, right? If you recall that, right? So, the financial security at the base level of the pyramid, right, is like having your passive income, meet your expenses. But once you've actually achieved that, right, the next level up is, okay, I want to help other people, right? Because that you're driving towards more fulfillment, enlightenment, and things like that. And 100%, you want to inspire people. You want to have leadership, like with your family, with those around you. The time, and this is also freedom, right, Hunter? I know you have some experience with a strategic coach, but this really chimes in right here with the 4 freedoms. Right? It's all about having freedom of purpose to do what it is you want to do, freedom of relationship to be working with who you want to work with, freedom of time as well. So, not only freedom of money.
Totally. I mean, look, in terms of like expanding your horizons or whatever, just let me circle back on this. It's really, really important. So probably the most baller thing that I have, like I said, not a car guy. I have a nice watch. It's not really my life, but I do have I probably spent around right when COVID happened. I got a note from Equinox that said, we're closing down. These are the new rules. And I was like, I'm out of here. I moved to the suburbs and spent about $10,000 or so on a home gym, like straight up CrossFit gym in my house. That is baller. And that is like, oh my gosh, like if I had $100 million, I'd have the same gym. Right. I was like, wow, that was right there at my fingertips. And now I live that mindset that I want to constantly be going to the next level. The problem, sometimes I find people when they try to play small, they're number one, taking away the potential jobs that could be created if they didn't. But number two, perhaps they're costing themselves on the net bottom line. So if you're in the Lambo game, for example, the higher of the level you play, if you got a Lambo and some guy goes, hey, nice Lambo, and you do one deal together, can pay for the Lambo that year. Maybe you could pay for the Lambo over and over again. And, depending on what circles you network in, you can see examples of this happen all the time.
Yeah. And you talked about it earlier, right? It's thinking in terms of multiples, and having a bigger game. And I think so many people, this all begins with mindset. All of this, has to do with, what type of investor are you going to be? And some people just can't get out of that linear growth, the linear path type of thinking. But, when you can move into, exponential numbers, it becomes amazing what's truly possible.
Totally. What you're advocating, by the way, is also just like the $10,000 gym idea. I think a lot of people hear the term family office and think that's like something that's out of their reach. And what you do and what you do for your clients is you say, you got a family office. You're living it right now. Just take control over it.
Right. Yeah, 100%. So this is an awesome conversation, Hunter. I know folks are going to really enjoy this, but I do want to spend some time as well and talk about, some things that I know you're really passionate about, and you have some strong thoughts, and the timing is really quite perfect as well. So why don't we talk a little bit now, switch gears and talk about the state of economy, what you're seeing. There's just so much going on, not even sure where to begin. So why don't you take us there?
Okay, so look, the reason you're asking this question is the reason that everyone's asking this question. There's a lot of really interesting and potentially concerning economic data points that are coming out right now, and investors need to be privy to that. So, I mean, the most notable thing, the thing that everyone's talking about, is the inversion of the two yield curves, the yield curve that everyone talks about, which is the 10-year and the 2-year. Yeah, that's right. So typically speaking, bond yields slope up and to the right. The longer the term of the bond, the higher the returns. And this is typical. If you think about you're incurring time risk, the further you extend things out into the future, you'd expect to be compensated for that risk. But every now and then, something like an economic phenomenon takes place where the shorter term bonds are actually higher than the longer term bonds. And it reflects fear in the marketplace, and it suggests that bond yields are about to go down because people are concerned about the marketplace, because people flood into bonds when things get scary. So bonds are a flight to safety. And so this recently happened. It happening is also kind of self-fulfilling prophecy to a large degree, because once it does happen, people know, they've seen the data, 80, 90% plus over the last 50 years, it signals that there will be a recession in the next 18 to 22 months. So that is just the math. That's the reality. Anyone can Google that. But there's a big difference between what that fact and what that means to us as investors. And so while that did happen, I'm personally extremely bullish on real estate for some data points that I can get into, but that's kind of setting the stage for the conversation.
Yeah, absolutely. So let's jump into that, Hunter. Let's go into some of those data points and get more specific.
Okay, so first of all, something that's definitely something that we're keeping an eye on, and it's maybe blowing up a couple of deals right now, is rising interest rates. Virtually every piece of real estate is purchased with debt, so the interest rates on which that debt is borrowed matters. But the reason interest rates are rising is because we have an economy that's quite heated up, but generally speaking, inflation is like at significant multi-decade highs. I'll talk about rising interest rates in a second, but a lot of people think about inflation as being something that's kind of a net wash to real estate investors, in the sense that real estate is thought of as a hedge against inflation. Like, inflation goes up by 5%, real estate goes up by 5%. No one's really in a position to complain as long as you have real estate. At least that's the way that I feel. Is that kind of your perspective on how most people think about it as well?
Yeah. Yeah.
Okay.
Which just to help listeners, right? That hedge is basically because we're able to increase rents over time, right? And that's offsetting the inflation, right? Because you have inflation in the rental rates.
That's true. The other piece, though, is just that, generally speaking, prices tend to go up, equities tend to go up, stocks tend
asset prices going up. Yeah.
Right.
Yeah.
And there is a distinction between asset price inflation and kind of consumer price inflation. But to your point, real estate is traded on a multiple of net income. And so it is not the case that it's a wash. It is a massive tailwind to real estate. And here's why. If most of the deals that we invest in, you're trying to buy some undervalued property where you can raise rents pretty aggressively, especially in the first 2 years, let's say 10 or 15%, to bring rental rates up to market rates. And then from that point forward, in year 3, 4, 5, and so forth, you would anticipate, if you're being conservative, for rents to increase at the same rate of inflation, assuming the value add strategy has already been completed. If that's the case, you would also anticipate that expenses would increase at the rate of inflation as well. So once you implement this value add strategy, and now you're just basically relying on market dynamics at that point, if inflation is going at 4%, rental rates would increase by 4% and your expenses would increase at 4%. If your product type had a 50% operating expense ratio, in the sense of net income to expenses was a ratio of 1-to-1, this would in fact be a wash. Everything increased by 5% or 4% or whatever, and it doesn't really change anything to the net. But that's not the case. The types of real estate that you and I invest in, mobile home parks, self-storage in particular, sub 40% operating expense ratios, multifamily 42% or so, depending on the product type. If the top line is increasing by 4%, the bottom line is only 35% of this whole mathematical equation. Then if both increase equally, the net is actually going to increase significantly. The net is going to increase significantly, let alone the multiple on which that income is going to be priced. So you're kind of getting the best of both worlds. But there's another piece of this that I don't think anyway. Does that make sense before I move on?
Yeah, it makes perfect sense.
Okay.
Yeah.
Did I say that in a way that's clear enough? It's kind of hard to explain without a calculator, but I know you're familiar with the terminology.
Yeah, no, understood. I think everyone will track that. It's logical. And I'm not going to steal your thunder, but I want to add something else to that.
Okay.
But I'll let you, I want to see what your additional point is here. Go.
This is why I like talking to you. Okay.
Yeah.
But the X factor that no one talks about as a tie-in to interest rates is that usually 60, 70, 80% of these purchases are purchased with debt financing. And inflation eats the purchase power of that debt. So if I buy a $15 million piece of property and I put $5 million down and the bank lends me $10 million, if inflation keeps up at 8%, forget the discussion around rental income and all that stuff. If inflation just keeps up at 8%, that $10 million of today's purchase price will be cut in half by year 10 just by inflation. The bank is paying you to borrow money. If inflation is at 8% and interest rates are at 5%, they're paying you 3% in real terms to borrow money to buy an asset, which will increase not just because of inflation in terms of the equity value, but also in terms of NOI. It's the trifecta of printing money, metaphor or whatever, intentionally done. That is what's going on right now. And there is $10 trillion making this happen right now that was just brought into existence over the last 2 years. This is one of those back the truck up moments. And everyone is sitting on the sidelines waiting for that back the truck up moment, thinking it has something to do with prices. And it's actually here. It is happening. Can I make one more point that's on this? I just put this together.
Yeah, it's perfect.
Part of my view on this is because I'm a big proponent of the Austrian School of Economics. And in pretty much everyone other than the Austrian school, the definition of inflation is prices increasing. But in the Austrian school, the definition of inflation is basically the increase of the money supply. So here's what that means. If apples are $8 an apple, and we enter a massive recession and they smash a $10 trillion button and apples are still $8, other people would think there's no inflation because apples are the same price. But I know that there's massive inflation. There's $10 trillion of inflation. It doesn't look like it in terms of pricing, but perhaps the apples should be $4. And that's what's taking place in real estate right now. And it's going to keep happening.
Yeah. Boy, that is so spot on, Hunter. And I believe that no one is talking about that. It's definitely not in the underwriting, right? So I know you and I share the same philosophy, right? As we're looking at deals and things too, we're always looking for places where, the numbers are being padded. There's some additional cushion. There's some additional savings, but no one quantifies this within underwriting. But as a savvy investor, right, you should be thinking about the future value of money, because you're spot on, because that's a really big impact in addition to all these other benefits that we've been talking about.
Yeah, man. It's just, I want to be conservative in my underwriting as well. I just want to intelligently participate. A caveat to this is I recently, not recently, but I've been talking about it for years because it was really a special moment in my career. I interviewed Ethan Pinner, who was credited with inventing the commercial mortgage-backed securities. And he basically was, having the same kind of view. Like, if you thought interest rates were going to rise in 2010, you invested incorrectly. Like, it does, maybe you were being conservative and you were only investing in deals that made sense if they, whatever, but you cost you and your investors millions of dollars. If you didn't take any floating rate debt, there are massive hedge funds, private equity companies that cost their investors hundreds of millions of dollars because they had no floating rate debt and were constantly waiting for interest rates to go up to 6%. Did they look conservative and they got to go on their blog and talk about how conservative they are? Yes, but there's the trifecta of investing. Be smart, get results, look cool. You can pick two. And so I'm going to kind of pick the kind of look cool and get results, and maybe not care as much about the sound smart.
Right. And not necessarily that, this would be in the underwriting, right, of a deal that goes out, but I want people to be thinking about this. I mean, you're an investor first, right? You have to have your investor hat on. So as an investor, these are, implications, calculations, right, that you should be thinking about as you're making some of these decisions, because it becomes even, more compelling, right, to add those in.
Totally.
So I guess to summarize that, right, in terms of, being in a environment where interest rates are rising, right, we've got inflation, pushing, probably over 7% right now. But what you're saying then, if I was to summarize all of that, is still by investing in real estate, right, you're going to completely surpass you're going to mitigate any of that by those things that we just talked about. Those
I gotta
several
give a
areas.
shout out. Yeah. Yes. And by the way, like, I didn't come up with any of these ideas. I'm not taking credit for any of this. I've just been able to interview some very high level people. One of which is Dr. Peter Linneman, who was recently on my podcast. If you Google Asym Capital or Hunter Thompson, you can find the interview, who's very sympathetic to a lot of this. And basically what he said is, he's not saying this is like, and it never is, this like massive once a generation type of opportunity in real estate. It's just that the predictability of outcome is really high. It's very favorable on a risk adjusted basis. What he said is, it's just your best shot. It's just your best shot. Like, it's not like this is the moon, this is Dogecoin 2.0. Like, it's not going to just do some crazy thing. It's just your best shot to produce outsized returns.
Yeah. So any other points, we talked about other data points that you want to talk about at the around the economy? We've already covered the inversion of the yield curve, interest rates. I think in the next 18 months, right, there's definitely a correction coming. I mean, people should be, probably leery and be thinking about positioning right now, right? Portfolio allocations, right, is a really wise time. And I've just gotten some interesting data points I heard. Now, this is on the single family real estate side, but in some markets in Florida, they're actually some of the builders, as well as some of the market, like days on the market, have just started to increase. And then also builders were literally like taking lots and, doing lotteries for the lots, but now they're inviting people in on the first day. They're trying to sell them. So I'm wondering if we've actually even starting to hit some peaks in certain markets on the single family side, which could, drive into commercial as well, right?
Man, it's interesting, but like, man, we got to put this stuff in context. Like, we just did a deal in Phoenix, which is probably my #1 market for multifamily in the country. And the first deal we did, we looked at the data at the time from May to May. And from a year-over-year growth standpoint, it was 15% year-over-year growth in the 5th largest city in the country. And I was like, that is a number I've never seen before. As we were going through due diligence, we kept tracking it year to year from month to month, right? So then it was June and it was 20%. From July, it was 25%. From August, it hit 33% year-over-year growth in the 5th largest city in the United States, like hundreds of thousands of units. And so when things started to slow down, the slowdown is like, it goes from 33% to 28% to 27%. So like, that's happening, but 27% is like an eye-watering number of rental growth. Rental growth is
Yeah.
non-volatile. Rental growth is created by sound fundamentals, income, net worth, jobs. These things are not like when Apple spazzes out and releases something and everyone thinks it's cool, but before it comes out, the stock market shoots up, and then it comes out, no one likes it, so the stock market shoots down. That's not like when 500,000 people move to Phoenix, they don't just bounce. You know what I mean?
Right.
So like
Right.
that's what's taking place. To go into that point, I think that, net worth increased by about 20% in 2020 and has stayed up in that range. So all-time highs in terms of net worth. You can make the argument that that's heavily weighted towards people that own assets, real estate, stocks, et cetera. When the money printer turned on, those things shot up. But that's exactly my point. This is what's happening. The divide between the haves and the have-nots it's going to go bigger and bigger. So I just don't want the listeners to be on the losing side of that. Something else, personal income per capita has significantly increased as well. And income is not traditionally very volatile. Now you could hear both of those data points and say, okay, if everyone's leveraged to the moon, I could see how that can happen. But the reality is, debt service, household debt service to income ratio is actually at a 40-year low. So those data points, combined with the fact that we have a legitimate $5 million unit deficit of housing in the United States, National Association of Realtors, look it up, or any other person, somewhere between 3 and 5 million. The fact that maybe some builders are having problems. Like we are in a crazy multi-million unit deficit that has not recovered since 2008. So those headwinds are small compared to the tsunami of demand and liquidity.
Yeah, 100%. So Hunter, I mean, just in some closing thoughts here, if you could just give one piece of advice to investors and our listeners about how they could accelerate their wealth strategy and trajectory, what would it be?
Dang. Okay. Can I take like 5 minutes for this? Because I don't want to rush. So I'm like a super productivity junkie. So like when you ask me like, what's the strategy to do this quickly? I have a system for this, kind of in this order. I would look, everyone wants to accomplish cool things, but anything that's worth doing, like you need to maximize these opportunities in life. Like when I started in this business, there was none of these cool podcasts. It's all readily available. So like the system is, increase the stakes significantly, find a coach, shorten the timeline, get some witnesses, and take massive action every single day. So as an example, about 2 years ago, I had a really bad wrist injury that made me not be able to lift weights. And so the moment it happened, I started looking for some way to kind of get my headspace out of this. I went through physical therapy. It didn't go very well, and it was a whole long story. But I realized the LA Marathon was 12 weeks away. And I was like, holy crap, like never run a marathon before. 12 weeks is shorter than a typical marathon buildup, which is typically 16 weeks. I just started running. I just got out of the house. I just ran. I ran 5 miles. Just day one, I know that every day is going to be really meaningful. If I only have 12 weeks, 10 weeks is kind of a build, 2 weeks is a taper. Like every day was going to really matter on the tail end. I got a coach on Instagram. It was $150 a month. She's a former Olympic trials competitor, had a marathon at 6:15s per mile. This is readily available, $150 a month. And then I told everybody that I was doing this. And then I took action every single day. When you do that, you have no other option but to make moves. I didn't rely on my willpower. Like willpower doesn't want you to get up and run a 10-mile interval workout in the morning. But when you realize it goes from the thought processes, oh my gosh, I don't want to do this, of thinking, man, how can I cram in one more? You think I can cram in one more workout this week without suffering from an injury? That's when your mind shift starts to change. So what I would do is, if Dave's your guy, go all in on Dave's view. Listen to every single one of these podcasts, become obsessed with the content. Once you get to a point where you're just like starting to hit a ceiling with the stuff that he's put out, reach out to him and say, hey buddy, I've listened to 3 episodes and these 3 ones are my favorite. Can I get 15 minutes of your time? And during that call, ask him what 3 books he needs to read to kind of go to the next level, and just constantly leapfrog faster and faster and faster. Tell everyone that you're doing this stuff and create some momentum. And then, by the way, this is such a hack. whatever the opposite of kryptonite is, people use kryptonite incorrectly, but Dave's kryptonite, or opposite of it, is that momentum you'll create for yourself. He cannot help but help you if you are making it seem like you're on a motorcycle going 150 miles an hour and you're just asking him, can I go an extra 10 miles an hour with your help? And he's going to want you to do it. So I got a little excited, but that's my vision of how to get things quickly.
Love it. Yeah, no, I know personal productivity. I mean, we're both very, very much passionate about that. And a huge shout out to Hunter. I'd be remiss if I didn't mention anything, but going on my second year in his mastermind for Raise Masters. So folks in this space who are, raising capital, growing businesses, just such a high caliber group of people, the content, and that, motivation and inspiration has been just awesome. So appreciate everything you guys are doing, Hunter. And, and it's also been, I'll say as well, just such a pleasure getting to know you a lot better as well. And, you're definitely the real deal. A lot of people that you meet, right, in different capacities kind of have a stage personality, and then they have one that's different off stage. But Hunter is the real deal. So appreciate it, man.
Thanks. I appreciate it too. I think sometimes my wife wishes that this was an act, but unfortunately, this is the real deal.
Yeah. Awesome. Well, really appreciate your time coming on the show today. I know everyone's really going to enjoy the episode. Where can folks find you, reach out, and learn more if they want to connect with you?
Totally. So first of all, I appreciate it, man. And I appreciate the 2 years as well. We're having so much fun, and that mastermind is way different than I anticipated. It's just awesome. So if you want to connect with me on LinkedIn, you can do so. Just search my name, Hunter Thompson. Holy crap. I do suggest, if you like this content, especially the economic stuff, search, cashflowconnections.com. Tons of great podcasts on there.
Awesome. Hunter, thanks again for coming on the show today. Really appreciate it.
Happy to do it.